Good morning, everyone. Warm welcome to the another session of CA Speakers Forum. Today we are meeting after some time as due to the clash with certain events and being a holiday period, we have not been able to meet. Today we are privileged to have CA Shashank Kumar as our esteemed speaker, and I express my gratitude to Shashank and all of you for being here today with us. Today is 15th of August when we celebrate, Indians celebrate our Independence Day, and most of the audience I see here on Zoom is Indian, and I express my gratitude to all my brothers and sisters on 79 years of independence and 80th Independence Day. Our objective with CA Speakers Forum is to spread the knowledge in those subjects where we need it or sometimes we do not talk about it. Now, today we have a subject, commercial finance, which is not a very common topic in different sessions. And our purpose today is to see that we understand from a specialist what goes into the subject and how it makes a difference into the organizations. And we are very thankful to Shashank today, who is here with us. Shashank is a qualified chartered accountant. He has close to 2 decades of experience, and Shashank is a commercial finance consultant. He has spent more than 15 years here in UAE, and he is always keen to share the knowledge. Thank you, Shashank, for joining with us today and being here to share your expertise on the subject that matters for every finance professional. Before I hand over the screen to you, is there any short message which you would like to give to the audience?
Um, so today's so today's message would be Happy Independence Day to all the members and audience here.
Thank you.
And thank you very much for the warm introduction.
Thank you. Thank you. So I request each one of you to please give a big round of applause to Shashank with all the emojis, with all the love. Please use it and keep yourself on mute if you are not speaking. And Shashank, you have seen the love, you have seen the grand welcome to you, and we are looking forward to go. I request all of you to please fasten your seat belts, focus on this session, keep your phones away, and let us make most out of this. Over to you, Shashank.
All right, thank you very much, Prabdeep. And thanks to all the members who have shown the applause and the love. I think Prabdeep has already introduced me very much in detail. Just to add to that, my area of specialization has been retail, e-commerce, and distribution, where I have worked for more than 16 years as a commercial finance professional. And since last year, I am doing consulting for these kind of organizations who are into retail, e-commerce, and distribution. So that is it. Now I'll share the screen and I will try to share whatever I have learned over the last 16 years I have spent in UAE as a commercial finance professional. So let me share the screen now. Okay, let me know if you all can
Yes,
see the
yes,
screen.
Shashank. Please. Yeah.
Okay, all right. So again, good morning, everyone. Let me start with a slightly uncomfortable question. So I know I don't want to build suspense in the beginning itself, but it's a very important question. I don't want you to answer this, but I'm just setting it up in a way that you understand where I'm coming from. So the question I have for you is, if finance continued to close the books, which it always does, produce reports, maintain controls, and ensure compliance, but stopped influencing the commercial decisions, what would the business actually miss? So this is more of a thought to all of you, that the finance function is being limited to what it was thought of traditionally, and not doing the work which is actually, I would say, equally important for the business. So after giving the food for thought, I would like to continue. So I want to organize the session around three major outcomes which every business cares about. So the three of them are growth, profit, and cash. So when I say growth, growth asks, are we growing the right revenue? So we will go in these concepts, and I would detail these things going forward. Uh, but the question which generally growth asks is, are we growing the right revenue? The question which profit will ask is, are we converting the growth into value, economic value, which is actually the main reason why any business operates. And the third would be the cash. And the question there is, are we converting the profit into cash? So commercial finance primarily sits in the middle of these decisions. It connects the customer decisions, products, channels, inventory, commercial teams, and investment to these outcomes. Optimizing one and ignoring the others would potentially be a disaster for a business. And we have seen many examples in the past. All of the disasters, financial disasters related are related to any of these three things, and where the businesses have missed to focus on one of these, and or entirely focused on only one of them. Okay, so the three basic questions which finance must answer. The first is what has happened, and that is the forte of a financial accounting team, which does a post-mortem of what has happened. So they don't have any influence on the decisions being taken in the past, and they simply show that this decision was taken and the result of it is this. So the primary role of financial accounting is to protect the value. The second part is FP&A, which gives you which moves one step forward, and it asks a question that what is likely to happen. So in financial planning and analysis, FP&A, we see forecasting, budgeting, and a lot of emphasis on the scenario planning. And the role which they play is to plan the value. So they are the ones who will be planning the value, and the the teams will be executing it. The third role is the commercial finance. Now you have seen the reports. Now you know the future plan. What action should you take? So I'm not going into the reports being generated by the financial accounting team, which is actually the cash flow and the balance sheet and the profitability statement. But what I am mentioning here is that their their trigger point is actually financial accounting also, if something has gone wrong, or it could be with FP&A when they plan the future for the company. So the influence there is the influence there is that how they can influence the decisions which are going to be translated into the financial accounting and FP&A plans. So, so the commercial finance primarily begins where the reporting ends and where the business choices has to be taken. Okay, so commercial finance actually, so I'm introducing the function in I would say in academic terms here, but you will relate to it when you see your day-to-day life as finance professionals. So for me, commercial finance is actually a loop. First, we understand the business and how it makes the money. Then it is translated into a proposed action which generates value and economics. Then the next role is to challenge the assumptions underlying which has gone into translating the plan or vision into the execution. Then the most important part is influencing the decisions. I'll come to that a little later. And here here the role is actually very wide, where you're not talking about the numbers, you're not talking about the cash, but you're going a step back and you're talking about the factors or elements which help in making these numbers. And ultimately, the last is last is a measure where you measure the effects of the decision which has been taken based on what you had suggested. So the problem is that finance often joins only at the last stage. I think a lot of you will agree to that, that all the decisions has been taken by the business teams, and finance only comes into the picture when it has to be measured, or it has to be, uh, it has to, I mean, or some scenario planning or has to be done. So that is something which actually is not, I would say, very suitable for a business. Now, so I'll give you a hypothetical scenario here where uh, where it is that stated in a monthly pack that your revenue is down 8%. So this is accurate. This is coming from the numbers which is given by the financial accounting team. But the question here is that what management is actually going to do with this information? Okay, we understand that the revenue is down, but what would be the decisions, or what would be the actions which management could take from this kind of information being provided? So now I'll break it down. So as I mentioned that retail e-commerce has been my area of expertise. So I'm sorry if some of you could not understand the the examples here, but I would try to be as generic as possible. So in retail, let's say I want to know the traffic, I want to know the conversion, I want to know the basket size. Basket size is nothing but average sales order value. And I want to understand the price and the mix of how the products are moving. Uh, Again, in e-commerce, these blocks would be sessions, conversion, what is the average order value, and how many percentage of the customers are repeated every duration. And for the distribution, it changes to customers and how much volume they are buying, and how is the price moving, and how is the mix moving. So this all provides you with the building blocks of how a number is arrived at. So when you talk about 8% revenue down, it's nothing but you have to go into the drivers of this number, and then analyze based on that that what has gone right or what has gone wrong. So as I mentioned, there are three building blocks which generally a company focuses on, and commercial finance should also focus on. So now I am coming to the first one, which is growth. So I have made a statement here that not all growth creates value. And if you, frankly, I don't need to give any example of this. You have seen a lot of new startups coming in your country. I'm assuming a lot of people are from India, and you have seen a lot of startups coming in, focusing on revenue only, building their valuation, and going bust. So this is something which everybody would associate here. Um, so the first play is growth, where most organizations naturally celebrate. Uh, the commercial finance introduces a different question, and which we already discussed, that which growth is worth funding? And the answer is not actually very simple. It depends on a lot of factors, some of which I have already explained in the last slide. Revenue quality, channel mix, growth tax, which we use in commercial finance, and the unit economics. So now coming to the revenue quality part of it. So this is, let's say this is a contribution margin statement. And I have not put the revenue line here. It is very much I wanted to do. So because in all cases, the sale is 100 dirhams. Okay. So now in three different channels of a business, they are generating equal revenue of 100 dirhams. But at the same time, if you see the different elements like discount or fulfillment cost or returns or commissions or servicing cost in case of distribution, you will see the contribution is, uh, let's say, the highest for the retail and the lowest for the e-commerce business. So the question arises here is the same 100 dirham revenue, which channel you would focus on more? Or is this information is enough to make that decision, or you need more information to make that decision? If you can write in the chat box or something like that, that would be great, so that I understand that you understood the question and you can answer. So it's just a thought that it is very easy to make a decision based on the number which you see in green, which is retail, that you will be focusing on more retail revenue. But eventually, there are a lot of lenses which you have to see this revenue from, which is revenue quality, channel economics, cost to serve, repeatability. And the I would say that the answer is not that straightforward. We'll come to this as well. Uh, so every growth, when I talk about growth, every growth has a price. So when you see a number like 30% growth, your CEO is celebrating, your sales is celebrating, your marketing is celebrating. But the commercial finance or finance as such would pose a different question here, which is how are we going to fund it? So this is one of the questions which you have to ask when you see growth or any kind of expansion or any kind of plan which states the growth of revenue or growth of the company. So again, now the funding part is a little tricky, which sales is not going into and marketing is not going into, and CEO might be able to understand, but may not focus on it. So this 30% growth is coming from, let's say, 35 million inventory, 18 million receivables, 10 million capex, and marketing and capability of 12 million. So seeing 30% growth in isolation is actually not advisable when you know that this is going to cost me something to attain that growth. So in commercial finance terms, we say this as growth tax. So how you are going to get the growth, what cost you have to incur to get the growth, um, which everybody else is celebrating. So the message here should be that we should be funding, as commercial finance professionals, we should be funding the growth which is worth having, and not all the growth at any cost, which, as I mentioned, a lot of these new startups do and eventually fail. The second part of the play is profit, and revenue is generally visible to all of us on a daily basis. If you work in a company, daily sales report and everything is published, but profitability comes at a later stage, and many a times it is hidden as well, because we follow some accounting principles, where we simply accrue revenue, defer costs, and these kind of things happen. Okay, I'm not saying that it is a wrong thing, but when it comes to the business, there are different parameters which have to be followed, other than accounting profitability. So there could be a scenario where your consolidated gross margin or EBITDA would look very healthy, where um, uh, when but there could be another scenario where the individual products or customers or channels are destroying the value underneath, and this is not visible from a profitability statement immediately. It comes at a later stage. So when we talk about P&L, so this is a presentation of P&L which we don't see as finance professionals. So as I mentioned in the example, so you have a consolidated EBITDA of 40 million, but eventually it could translate into a 70 million profit or a 30 million loss. The way, I mean, depending on how much other elements are attached to it. So there could be multiple scenarios. These are just reference scenarios where your product is performing well, your customer is okay, doing okay, your channel is struggling, and your location is like sometimes good, sometimes bad. In the second scenario, product is doing okay, customer is not doing okay, your channels are okay, sometimes profitable, sometimes not, and location is good. So these are the scenarios, but eventually the profitability is derived from the customer, product, channel, and location uh, uh, element. Okay, so another scenario which I'm presenting here is you have a customer, and which is doing 20 million annual sales for you, and it is offering you a 20% increase in the volume. Will you take that deal? The question here is that you have a customer and you are getting 20 million in annual sales here, and which offers you a 20% volume, additional volume. So this is actually something which you cannot answer now. Now I'll go to one step deeper. Now the ask from the customer is that they want 3% price discount, 90 days credit period, they want free delivery, and they want 2% marketing support. So now the overall picture is starting to build, that where you will come into the picture as a commercial finance professional, and you have to create scenarios where you will take the cost of all these four elements which the customer is asking, and compare it with the additional growth which they are providing. So the question straight away cannot be answered. There could be three answers: yes, no, or need more info. But as a commercial finance professional, you have to always go for need more info. See, one thing also I would say, that finance has a very bad reputation of saying no to business decisions. And a lot of people who are in the industry will agree to that. The commercial teams or the sales teams come with a proposal, and finance teams generally see the numbers only in black and white and say no or yes. based on that. But as a commercial finance professional, you should always take a step back and go deeper into the ask and look into it whether, uh, as the question said, that every growth is not worth funding. So you have to see it from that lens. So here, the missing information is, let's say, incremental margin, how much we are going to get, how much is the cost to serve, how much will be the impact on working capital, or increase or decrease in working capital. What is the credit risk associated to this customer? What would be the logistics cost? What is the cannibalization? If I supply 20% additional merchandise to one customer, how it is going to cannibalize my other customers or other stores or whatever it be. So the role which we play here is that a sales opportunity is presented to us and we have to translate into a business decision. It could be a yes, it could be a no, but we have to take that decision. Now, a very important element which we address to as a commercial finance professional on a day-to-day basis. So I mean, you can see the example right now, what is happening in this region. So the businesses are under pressure to build additional revenue, to build, or I would not say additional revenue, maybe sustaining the revenue which they already have. Then just maintaining their profitability or increasing their profitability. The point here is that the next 10 million which you want uh, could possibly be within your business itself. You don't need to go outside and look for customers, or you don't need to go and look for the ways to reduce the cost. But eventually, there are a lot of factors which goes into this 500 million revenue, which is hypothetical revenue here. So you can work on pricing, you can work on discounts, you can work on promotions, returns. You can talk to your suppliers for additional rebates, work on your customer terms. You can change your assortment to suit your margins positively. Channel mix, cost to serve. So and these are the areas where the majority of leakages happen. So giving any unauthorized discount in a retail store is a form of revenue leakage. Probably for on a transaction basis, you will see a 10 dirham discount on a transaction. But when you accumulate and when you see it in totality, it could probably be 1-2% of your revenue, and that itself translates into additional 10 million to the bottom line. So you have to see it from the lens, multiple lenses which are mentioned here, and probably clicking if one or two clicks, you will be sitting with additional revenue, additional cash at the end. So sometimes the fastest value creation is fixing the bucket and not pouring in more revenue. Now, moving to the third part of the play, which is cash. And see, I'll give one statement here, which is actually which I feel that it would make you think that profit does not fund the payroll or the suppliers or the expansion. It is the cash which does. And the important commercial finance insight is that cash flow is created long before when the cash flow statement is produced. So we are producing cash flow statement what on a monthly basis, but the which is reflecting in that cash flow statement is already generated. And frankly, in finance generally, we only do the post-mortem work, and The commercial finance role is to influence the drivers which is generating that cash. Uh, when I say that cash is generated much before a cash flow statement is generated, this fact also confirms that it is generally created outside the cash flow statement. You will not be able to see the elements which go into the cash generation in a cash flow statement. So when I say this, it means we are talking about, let's say, customer terms, which is nowhere visible in the cash flow statements, but receivables is something which translated into cash flow statement. Then ordering quantity or buying, which builds your inventory. The idea here is that we see only the receivable, inventory, working capital, cash conversion, or payment terms, but the translation happens much before. When you are negotiating the terms with your customers or suppliers, or when you are making expansion plans, or when you are when you are getting the settlement for your e-commerce transactions, or when you are doing negotiation for your payment terms with your suppliers. So that is the decision which is going to influence your cash flow. And cash flow statement comes at a much later stage, translating those decisions into cash values. Okay, there is another scenario where uh, your sales is growing by 10%, but your inventory is 32% increased. Whether you consider this as a good growth or a bad growth. So again, the answer is not very simple. Inventory has its own cycle. So once you get the inventory, after that, it improves your availability, it improves your sale. Then you have to do the markdowns to clear it. Then it translates into margin and eventually in cash. So it has the complete cycle. And it does not, what it does not tell you is that the seasonality sometimes, because your inventory might be higher in certain seasons and lower in other seasons. So the benchmark cannot be fixed. That is something which we see generally in traditional finance departments, that they're stuck to a number, or 4 months inventory or 3 months inventory. Now, understand. Now, I can give you one example right now, which lot of the businesses are facing right now. We have logistic delays because of the situation in this region, and you had a you had a tradition of maintaining, let's say, 45 days inventory in your business. Now your lead time from China has gone from 35 days to let's say 60 days. Does your assumption of maintaining inventory for 45 days hold true? I would say it depends on the business, how good is your supply chain, but eventually majority of the businesses will answer this question as no, because the scenarios have changed. Now you are forced to build more inventory in order to serve your customers. So the answer is not that simple, but the flip side of it is that you are building an inventory of, let's say, uh, for against 45 days, you are building an inventory of, let's say, 75 days now. It might result into a dead stock, which is not moving, and it is taking space in your warehouse, and it is taking a lot of time, which we generally don't measure. A lot of time for finance professionals and management to take decisions on this dead stock, additional discounting, markdowns, which you might have to do, and eventually the lost opportunity. So the dead stock, uh, we use a term called dead stock tax, which is nothing but the cash which is stuck, then space which is it is occupying, which has a cost in your warehouse, and then you're handling maintaining that inventory and handling that inventory, then the markdowns which you might have to provide, the attention from the stakeholders, and the opportunity you might be losing. You might be cutting down your next season's buying and frankly reducing your full margin sale and replacing it with a markdown sale. So another statement to think for you is inventory is cash waiting for a customer. So we have covered the parts of three parts of the role, uh, which is growth, profit, and cash. So commercial finance sits in the middle of these three elements, and the questions are very specific. That growth is asking whether we are growing the right revenue. The profit will be asking whether the growth converts into value, and the cash will be asking whether the value converts into liquidity. And these three cannot be managed independently. Uh, a promotion may improve the growth but damage the profit. A tight inventory may improve the cash but damage the availability. And generous credit may increase the sales but weaken cash positioning. So commercial finance helps the leaderships see the trade-offs and make the best enterprise decisions, and not optimize one KPI in isolation. So the timing of finance involvement also matters, as I discussed earlier. Uh, Before a decision or a challenge economic situation, uh, assumptions, scenarios, and break-even points. Uh, but at the time of execution, it has to monitor the indicators and expectations also. And eventually, it has to measure the outcome and capture the learning. So it cannot go into, so it has to be a loop, and it has to answer all these three, address all three things which is mentioned. So many finance teams are very good in doing the postmortems, as we see, and financial accounting. With all due respect to financial accountants, they are very good at it. But commercial finance need to do more pre-mortems and not the post-mortem, because they are the ones who will be influencing the decisions. They are the ones whose decisions are going to influence the three basic elements which we talked about, um, which is growth, profit, and cash. So, as we discussed, that the answer is never straightforward yes or no. And you have so commercial finance has a posture of adding yes if in all the decisions, all the questions which they answer to. So let's say marketing is coming up with a proposal of increasing 25% promotion. So the answer here is yes if the volume protects the contribution. So it's never a straight yes, straight no, because it will not give you the entire context, and may not be beneficial for the company as well. So increasing 25% revenue straight away, meaning the margin is lower and your ad spends might be higher. But eventually, if it is able to protect the contribution which you are expecting, then why not? Again, the sales comes up with a scenario that we want to extend 90 days credit to a specific customer. Then the answer is yes if the margin exceeds the capital plus risk cost. Then operation might ask you for more inventory. The answer could be yes if the sell through supports the investment. So at the same time, this requires this kind of approach requires commercial guardrails, clear thresholds, and understanding how much expectation it is going to meet in terms of the business or economic value, and and it also requires the skills beyond finance. The commercial finance person should be curious. They should have commercial acumen, understand the business model. They should be able to judge analytically all the situations. And eventually, at the end, they need to be a good storyteller and influencer as well. So that is what is expected from a commercial finance person. So now to summarize what we have discussed so far. So if you ask me to summarize the slide in 1 minute, it would be these are the these are the and I would like you to take the photograph or take a screenshot and keep it with you. Uh, when you enter a business discussion, you have to ask these 7 questions. And the questions are like, what actually drives growth? Which growth creates value? Where do we really make and lose money? Where is the value leaking? Uh, what is where is your capital trapped? What needs to be true to this decision to work? And finally, what should the management do differently? If you are able to ask these questions and if you are able to understand the answers to these questions, you are a pure commercial finance person, I would say. And you do not need a new system to start doing this. Pick any recurring decision in your business, in your existing role, whether it be pricing, promotion, inventory, customer terms, channel expansion, and move the finance one step earlier in that decision-making process. So I hope you have taken the screenshot of this slide. So, so let me leave you with one thought here. Uh, the job of commercial finance is not simply to tell the business how it performed. It is to help the business decide how it is going to perform. And you need to understand the business, you need to understand the economics. The most importantly, you have to challenge the assumptions which businesses might be having maybe for a long, long time. Then you have to influence the decision and measure the outcome. If the business makes a better decision because finance was in the room, finance has moved beyond the numbers. Thank you very much.
Thank you. Thank you so much, Shashank. Uh, I request everyone who is here to make note of Shashank details if you would like to connect with him. And Shashank, the emojis, the love which delegates are showing, you can judge from it that how much impact this session of yours has made to everyone here. And as we have a few minutes left, I would request the audience here to uh, get ready for any questions you may have, or if you would like to make a short comment which can make a difference to everyone, you can raise your hand or you can unmute yourself, and then I can invite you to ask your question. Yes, so we will start from Amanjot. Maybe Shashank, you can stop sharing the screen now. I think that,
Sure.
yeah. So Amanjot, you can please unmute yourself. And Amanjot, can you hear me? Can you please unmute yourself? Yes, please go ahead.
Hello, good morning, sir.
Hi,
Yeah.
good morning.
Oh, and thank you, sir, for such a wonderful session. Sir, my question is in the retail sector, there is a lot much inventory which is required, and because of that, so much working capital is stuck. So right now in
Yes.
the industry in the UAE, so is there any like company or just in time we can do so that we can reduce that working capital period and we can save that money?
Okay, so yes, your question is actually very relevant, and as I mentioned in the presentation as well, the answer is never very straightforward. So it
Hmm.
depends on the inventory you are, it depends on the industry you are in, and
Okay.
what kind of products you are dealing with. So there are some products which might be available very frequently for which you can maintain a just-in-time inventory. So you get the order, after that you reach out to your supplier, the stock is always ready, and you can straight away place an order and get the inventory. But it may not be possible for a lot of industries. Let's say I'm talking about fashion, and you are operating a brand. Okay, so it becomes very difficult for you or your supplier to maintain that kind of inventory, and especially locally to get it just in time. I would say that if you are into a food stuff business or if you are into a commodity business, is simply stating, then it is still possible to maintain a just-in-time inventory. But if you are in a different industry and your products are different and which requires some time to get prepared, and it cannot be prepared within UAE or regionally, then it becomes very difficult to do a just-in-time inventory. So in my previous experience, when I was working for a electronics company, it was very easy. Just place the order to your local distributor and they will be able to supply it. But when I talk about the fashion company which I was working for, it was very difficult. So the entire cycle was minimum 90 days.
Okay. And sir, one more question, if you
Hmm.
allow me. My second question is regarding the credit period. So
Hmm.
mostly the customers, that is also the thing that the our amount got stuck for that particular period. So how we can reduce the credit period to very low level so that our cash will be circulate in a minimum time.
Right, right. So this is actually a very interesting question, and every finance professional would be challenging this question. I mean, challenging their operations team or sales team by raising this question. See, frankly, it is easier said than done because especially in the market when you talk about the big customers, the
Mm,
big customers, like let's say for example talking about, let's say you are into a food business and you are dealing with Carrefour. It's very difficult to go to Carrefour and
mm,
ask them to reduce the credit period. They will be ready to discuss with you the other side of it, the other way around, if you have to increase the credit period, but they will never see in that situation. You may have to you it would be commercially wise to calculate your cost of borrowing and see whether, if you are getting that kind of discount, if you're getting that kind of I would say, if you're offering that kind of discount to your customer and getting the cash immediately. So
mm.
that I think is one of the ways you can work this out. In one of the organizations where I was working in distribution, we were doing bill discounting, and we simply used to raise the invoice, and within 3 days we used to get paid by the bank.
Ah,
But there was a cost associated to it, and the cost, I mean, if your cost is recovered, is recovered by the way of getting cash immediately, then why
mm.
not?
Okay, sir. Thank you, sir. Thank you.
Okay, thank you, Amanjot. Bijay, you had raised your hand. If you are there, can you please unmute and ask your? Yes.
Hi, good
Yes.
morning. Thank you, Prabhdeep, for providing the
Yeah.
opportunity on the platform, and
Yeah.
thank you, Shashank, for presenting such a
Yeah.
nice
Most welcome.
insight information. So, I have one question. In this, the whole plethora of the commercial finance, and if you talk
Mhm,
about even finance business partnering, a penny role, how
mhm,
the information technology, how the IT is going to be a disaster or be a supportive? Because I had an experience where we
mhm,
found a major deficiency in our IT system and which made a huge inventory. And as you mentioned rightly, that the opportunity loss that you have done basically, because the especially if you talk about the fashion brands,
mhm,
and I cannot take the name, but some of the brands recently got closed, and I believe
mhm.
IT would be one of the major supportive role in making success. What is your suggestion? What you perceive and what you have experienced?
Okay, so IT systems, when you say, see, I'm just repeating the question if I understood it correctly. So when you talk about IT system enabling your day-to-day operations, or IT systems with the use of new technology or something like that you're talking about?
I mean, basically, the obstacles that I have found when your front end doesn't talk to your back end, basically the pause, because the inventory
Okay.
movement happens from there, and when your inventory is rightly moving and it's affecting your finance, then you are making
Hmm.
a right decision. Your event planners are able to match the requirements, and you're basically for the fashion brands, you're getting
Correct.
the timely delivery of the inventory.
Right. Right. So, see, I would say, see, I understand where you're coming from, and this is a very common problem where your front end system doesn't talk to your back end system very well. But see, this is the role of the financial accounting that it should talk. And frankly, even if it is not feasible uh, by IT intervention, then unfortunately you have to do it manually. I understand the transaction volumes are very high in retail, and which makes it very difficult to manage it. But eventually somebody has to do this job, whether it is IT or whether it is finance. So if both the systems are not talking to each other, there would be some discrepancy arising because of that. And that discrepancy will have a financial number or a measurement to it. And if it is not visible from your reports, or if it is not visible in the statements which are coming, then I would say that finance is equally responsible for that.
Yeah. Thank you.
Okay.
Thank you, Shashank. Thank you, Vijay. Verna, you had raised your hand. If you are there, can you please unmute and ask your question? Yes, Verna. Please
Yeah,
go ahead.
hi, Prabdeep. Thanks for
Thank you.
this session again. I look forward
Yeah.
every weekend to you listen to you and the guest. And thank you,
Mhm.
Shashank, for a very nice, lovely walkthrough of a mindset of a finance expert. My question to you is, do you know of ready products that are available for invoice, encashment?
Okay, all right. It is more of a treasury area, but yes, invoice encashment. I have done bill discounting, and if you have customers like Carrefour and all, they do supply chain finance as well. So these are the products I'm aware of, but I believe you should get in touch with a treasury person, and they will be able to guide you about the product. I understand the mechanism, but I cannot straight away say that these are the ready products available. Many banks do it, and frankly, they have good margins in this kind of business, and that is the reason why they are doing it. But these are the only two things I'm aware of: supply chain finance and invoice discounting.
Okay, thanks so much.
Thank you, Verna. Hari Krishna, can you please
Hey,
yeah.
hi, Prabhdeep. Thank you so much.
Thank
Hi,
thank
Shashank. Thank you so much for the session.
All right.
I was just thinking around
I think he dropped
Uh,
out.
yeah, yes. Hari Krishna has dropped out. Maybe we'll wait for a minute. Anyone
Yeah, sure.
else has any question or any statement? Yes, anyone has any question? Uh, yeah. Thank you so much, Shashank, for your session today. And I would request everyone to please express your love as we close for the day. And today, it feels good, to have a topic which is different from taxation and IFRS, which is in demand always. And that subject making a difference to the audience is that great feeling. Though those are the subjects which are more in demand and we get more audience for that. But even if it makes a difference to certain finance professionals, our work is done. And thank you, Shashank. Thank you for sparing your time on August 15th when Indians are celebrating Independence Day. And we took the courage to do this session when many may be busy in different
Yeah.
festivities, different celebrations. And this is the first session we have done in the month of August. And the holiday season, as I said in the beginning, has disturbed the schedule. On
Hmm.
August 22nd, we will be again taking a break and we will meet on August 29th now with a session on taxation, where practical challenges and corporate tax, for what may be the practical challenges or queries in a corporate tax audit by FTA. That is the topic which will be taken by CA Mahesh, DRG. And hopefully from September onwards, we will be regular. And yes, so Hari Krishna is back. Shashank, we will take his question
Yeah.
and then we'll close.
Yeah,
Yes,
sure.
Hari Krishna. Yeah,
So sorry, yeah,
yeah,
I dropped off
yeah,
unexpectedly.
yeah,
So,
please.
Shashank, we often see the business promising high and rosy picture all the time, and end up you see the same thing repeats again and again. How do you deal with this in real business sense? Because many a times they promise a capex. Okay, you bring this machine. I am promising so much revenues. I will expand this capacity. I will do this. I will go into that product portfolio. I can pitch
Hmm.
to more customers, and they promise high and rosy picture every time. But then you end up seeing the same thing. Like they promise $100,000, you end up getting only $10,000, and
Hmm.
that's been the case. Like I've been seeing it's past so many years. So how
Hmm.
do you practically challenge business team? So I mean, we are blamed for saying no every time because they keep promising the same thing and deliver the same old stuff. So
Correct.
I think when we back up with our data and they feel offended. So how do you deal with these kind of stuff?
Steve, one thing, whether you're a commercial finance professional or not, one thing has to be very clear that as finance, we have a say. And it could be no. When you know that there is a history of over-promising and under-delivering, then from the history, you are always right in saying no. So there is no harm in that. That is the first thing. Secondly, that actually becomes the talking point for you as well. That last time you had promised this and not delivered, and it has been going on since long. So, see, I understand people will get offended, but eventually, if they're not performing the way they should be, or they are not delivering the results the way they should be, then there's no harm in offending anyone. That is my that is my way of doing things. And I would say in my tenure with various organizations, I would have offended a lot of people. But eventually, you are there for the business, not for anybody else.
Yeah, yeah, Hari Krishna. are you
Thank
satisfied
you.
with the answer?
Yeah.
Yeah,
Thanks, sir.
okay. Thank you,
Most
Hare Krishna. Thank you, Shashank. Thank you, deep gratitude to you. Once again, I remind everyone that we'll meet on 29th of August for taxation. Have a good celebration, everyone. Take good care of yourself. Thank you, Shashank. Take good care.
Thank you.
Bye-bye.
Thank you everyone for the love and support you have shown me. Thank you. And if you want
Thank,
to reach out to me, you can reach out to me anytime.
thank you.
Thank you.
Yeah.
Thank you, Shashank. Thank you,
Thank you,
Pradeep sir.
Shashank.
Thank you.
Thank
Thank
you,
you.
bro.
Bye.